Hi, everyone. Welcome back to Making Multifamily Money. So today I'm bringing back Wakefield because I felt like on the last episode, we kind of touched the tip of the iceberg. We kind of ended that episode talking about scale. So without further ado, just want to throw it back at you, Wakefield, and kind of share about your scaling timeline and kind of your mindset throughout that whole scaling process.
Sure. Yeah. Would you like me to start from the first deal or where we
Yeah,
just from the
from the
first
first
deal?
deal. Yep.
Okay, sure. So as I mentioned in the last episode, we started in multifamily. I had that background in multifamily and knew that it would make sense for us to just start bigger out of state. And we thought actually that might be potentially a little bit less risky because we have more units, it's a more stable building, and that would make it more worth the time and the effort of actually going out of state. You have to fly out there, you have to underwrite and talk to a lot of brokers. And so that's where we decided to start. So in 2015, we got that 28 unit off of LoopNet. We bought that one from the broker and we wanted to move quickly on that. So we saw the deal in 2 or 3 days. We put in an offer, got it under contract, negotiate, and closed it within about 60 days, standard bank financing. And then after that, then we almost got lucky in a sense. And sometimes they call it the you might have heard of this, the law of the first deal. So the first deal is the hardest one to get done. And for us, it was hard. We looked at 50, 100 plus deals before we got to this one, lost some money on a previous deal that didn't work out and eventually got here. And this deal was key for us because once we got this deal, we developed a relationship with the broker. So broker relationships are super important when you're looking for deals or alternate way to go off market, right? But for us starting in the market, we and at that time we just thought, okay, our connection to the deals is through the brokers who have the relationships. So we bought that one, and then that same broker continued to bring us more off market deals. So the second deal that he brought after that, about maybe 6+ months ago, was a 43 unit. So we looked at that deal. We did our underwriting, we did our diligence, and that one also looked good. And so same type of process. They wanted a high price, and we did our numbers. We tried to be conservative and said in place rents. We weren't even looking at upside, renovation, any of that stuff. Just what are the rents today, and what do we think we can get for it, and how do we operate it? So we bought that deal, and then about a year later, same broker brought us another deal, also off market. He just had a lot of relationships, and that deal was a 12 unit, so a little bit smaller, but still a very nice deal, and 1990s build. So that was just a really good one to keep. And actually, it was very close to our initial 28 unit deal, probably a 5 minute drive. So we thought that that would fit nicely into the portfolio. And as I mentioned in the last episode, I actually took a break for a couple of years. So there was a gap between 2017 and the next deal that we got. Part of the reason for that was because of my W-2. So I took on a pretty intensive W-2 at a private equity firm that was buying these big deals, big shopping malls across the country, think like Westfield, Simon, etc. And I was working 60, 70, 80, 100 hour weeks and just did not have the bandwidth, the time to keep looking at deals. But I guess at that point my focus was my career. So did that for a couple years and then realized somewhere around 2021 that I wanted to get back into the market. And then also during that time decided to go back to grad school, which is another kind of pivot point for me. And but I learned a lot in grad school, met some good people that I'm working with now actually in my company, and created a lot of good relationships. And then after grad school, I took another job in asset management for a developer, multifamily developer, and then wanted to start up this company and make it more formal. So 2022, last year, founded the company called Meridian Real Estate, which is the company that I'm currently operating. I have a few partners in it and some part-time staff, some interns. And the goal was to really just scale up and do a lot of deals. So 2022, we developed a system to just be very active, make offers, do a lot of outreach, and just constantly be in the market. And that's, I can talk a little bit more about what our strategies were there and what worked for us and what didn't. But in general, we made a lot of offers, and we bought about 5 6 deals last year. So quite active for us, and we got some smaller deals, we got some bigger deals. One of our bigger ones was a 41 unit, which we closed. That was through a broker relationship. And coming into 2023, the next part of the scaling that I knew I wanted to get to was to syndication. And a couple of reasons for that. One was just we had been working on joint ventures through that up through that point, and it was working well. It was fine, but eventually we knew that we would we'll only have a limit to the number of amount of funds that we have. So we were looking to bring in other partners, and we felt we had good experience being doing this for about 8 years now, and coming from that real estate background. And that's when we decided to get into syndications. So in early this year, in January February timeframe, we had our first syndication opportunity. It's a portfolio of 3 properties, 133 doors. So that was my biggest project yet that I've worked on just personally for myself, being a lead. I worked on bigger properties for other large companies, so I felt comfortable from that underwriting perspective, being able to manage it. But this is different because we were bringing in other partners and raising capital and bringing in investors. So it was a challenge just to get the deal done, negotiate. Pretty tough process. A lot of nuances involved of the credits, rising interest rate situation. It was just a lot of challenges that come up, and then putting together the team. So finding the right co-GPs and making sure it's a fit, and then also actually working with investors on the funds. So that is but we closed the deal actually about a month ago. So I was in Ohio, Cincinnati for that. And we've raised most of the funds, and we have just a handful of spots left. So we are looking to fill those probably within the next about 3 or 4 weeks or so. A couple more spots available, and then we are looking to continue to do more. So more of the syndications, which offer passive investors an annual double-digit return, no work involved. We do all the work. And then for joint ventures, which are a smaller group of individuals, usually a bigger investment amount, but actually just owning the asset with a few partners. So that's our strategy now, and what we're doing.
Okay, great. No, thanks for sharing that. Just kind of as a recap, so it seems like from 2015 to 2017, that's when you worked with the same broker. You got the 28 unit, the 43 unit, and the 12 unit. Is that correct?
Yes.
And then for that one, was it the same partners that you worked with for all three of those deals?
Same partner groups. Yes.
Okay, great. I guess my question would be like, how did you find your partners? Like that partner
Yeah.
group that you've been investing with?
How did I find my partners? So, being based in Los Angeles, most of my partnership groups were also out of California, and we had the same type of pain point, right? Which is we are interested in doing real estate, finding some passive income, finding some good projects to get involved with, and the local area is just really tough. Cap rates are not good, the ROI is not good, cash flow is not good, and so that's how I met some of my partners. I'd worked with some of them before, just looking at deals and saying, "Hey, are you interested in doing this? This is what I'm thinking. Do we line up? What's our long term goal? And are things are we kind of on the same page with that?" And then gradually, as I did more deals, then I got more partners. So kept talking to more people and networking, and then different people said, "Hey, I am interested in real estate and want to do something with it, just not exactly sure how." So that's how I worked with a couple more partners and expanded it a little bit more, but still it wasn't a lot of partners. Even to this day, I don't have a big list of joint venture partners. It's still a few people that I work with.
Okay, got it. Just because why I ask is, for me, I have 90 units about partners, right? And for me, well, number one, I was bad at networking, and then number two, obviously there's some risk and benefit with partnerships, right? So have you kind of experienced any kind of, I mean, obviously the good side is dividing and conquering, right? Like you might have complementary skill sets. You have kind of like a group to discuss with any, decisions that you make. But obviously there's some, negatives and downsides as well. Have you kind of experienced any of that negative side, I guess, through your experience with partnerships so far?
Yeah, yeah, it's definitely a good point, and like what you're saying, I think there's definitely pros and cons, right? And it's definitely nice to own your own units and run them on your own, and you have all the ownership and all the benefits and the equity that comes with that and the cash flow. I would say the pros of it were just other people to bounce ideas off of, right? And saying, hey, this is what I did on the underwriting and the rents. What do you think? Does it make sense? And they might say, well, I think that's too aggressive, or we can push it up a little bit. And just being able to bounce ideas off of people and say, okay, so how do we negotiate the price, things like that. And some of my partners are pretty experienced in real estate. Just they brought a complementary skill set from being realtors or having negotiation experience, having general contractor experience, and there was a good complementary fit, I think. So I was probably less strong at the general contracting sort of construction aspect of it, and so my partners were quite good at that and did that for their work or on other projects they knew and said, well, this is going to cost this and it's going to take this amount of time to work. So I was learning from them, they were learning from me, and we each kind of brought different skill sets and experiences to the table. Now, as far as the cons, I would say just like with any partnership, if you don't see eye to eye, you can have some disagreements, right? So what's the long-term vision? Do we want to refinance this? Do we not want to refinance this? Do we want to sell? Do we want to buy more? And so over time, we've seen what the differences are between what my vision is, what some of the partners' visions are, and they are a little bit different. And so with some of my partners, I have actually exited partnerships. So either through a buyout or just saying maybe let's sell the property and we can do our separate strategies and execute our goals in our own way. So that's been one way. And going into this business, didn't have sort of the 20 question checklist from yeah you ask your co-GPs or your partners of, hey, this is how you vet each other out and all this stuff. I did not have any of that, so didn't really have a sophisticated way of doing it, and so just learned it the hard way. Now luckily there hasn't been any really like major I guess mistakes or things that have been lost. Now definitely disagreements and some arguments about where to go and direction and things like that, and at some point just decide, okay, we're just going a different direction, which is okay. And now so that was kind of the turning point of where I decided to start my company at Meridian 2022, and then exit some partnerships. And I would say some of those early deals, which I appreciate for my partners, is that they were willing to work together and joint venture on some of these deals, and those deals did quite well. And so, based on those deals, the success of those deals, I was able to kind of kickstart my company with some amount of investment that I could continue on my own, and then continue to look for other partners.
Okay, great. No, thanks for sharing that. And kind of the point I want to emphasize is that, like when you initially start a partnership with somebody, right, it may work in this time, but as 5, 10 years goes by, obviously we all progress and advance, right? And our goals might shift too. It's really hard to predict. Like what I wanted 5 years ago compared to today is different. So as you kind of mentioned, there's going to be some circumstances where, yeah, you may be on different paths, or maybe, one partner is going through divorce, death, or maybe their motivation, they're not as motivated to do real estate anymore. So just something to definitely consider. I guess that's what kind of initially turned me away a little bit, because like I'm a buy and hold investor, but obviously if you bring in a partner and their life situation changes, then you might kind of be forced to sell, or maybe it just doesn't go well anymore. So for me, that's why I kind of chose the non-partnership route. But definitely what holds you back is, yeah, you cannot scale. Obviously you're dependent on your own capital, and then also like you have no one to bounce ideas off of sometimes, right? Which is kind of why I host mastermind groups, is for people who kind of want to do it themselves. And it's sometimes nice, like, I bounce a lot of ideas off, like, um, like my girlfriend or even other people who know like real estate pretty well because they're just around me. But no, that's great. It sounds like because I've heard the other side where people had really bad experience with partnerships, but it sounds like yours have been pretty, for the most part, like okay, nothing like tragic or life changing or ending. So that's amazing. So let's kind of fast forward to 2022. So this is kind of when you started your own company, and you said you mentioned 5 to 6 deals. Like, how many units was that? 5 to 6 deals.
Yeah, the total unit count on those 5 or 6 deals was, I think, about 80 units. Yeah, so it's about 80 units total, and varying. The smallest one I think we did was duplex, and then the biggest was 41. So big range of deals, and the goal was for us to just get momentum. So making a lot of offers and just trying to be out there as much as possible. And if we see a good deal, we'll just try to get after it very quickly. And so it was high volume, and I actually learned that from some other people who said, "Hey, this is how you get deals. You just have to make offers." It's almost like if you're a broker, and how you get listings is you just have to make a lot of phone calls and talk to a lot of sellers. So it's the same kind of I don't know, sales mentality, you could say. Just keep getting a lot of at bats, and try to see how many hits you can get, type of thing. So that I hired some people, so that was a big thing as far as scaling for people in the audience. I think definitely it's you can do a lot on your own, or you can even hire people. That's what I did. So partnerships, hire people, get VAs, different ways to do it. But I found that bringing on more people to help was really a huge benefit to the scaling effort, because I can only do so much by myself, basically. And I still had some of my prior deals with partners, but I wasn't really pursuing some of these new deals with my existing partners. So it was me and some new partners. And so I was trying to really just almost rebuild my track record in a sense. And then the idea was to get that momentum, develop relationships in the market, tell brokers, hey, we are continuously closing deals and we are looking for more. So that led into our momentum of earlier this year of getting this portfolio project of over 100 doors. So a lot of those, even though they were smaller deals, they at least showed that we were in the market. And it's pretty interesting. I don't know if you've seen the same thing, but if you close a deal with a broker that maybe is smaller, could be 5 or 10 units, and you say, hey, look, this is my buy box, they might have a 50 or 60 unit deal and say, hey, are you also interested in this? Which was surprising to me, because when we closed a 4 unit, why would we want to close 50? There's such a big gap there. But just developing that relationship and showing a broker that you can close, that means, look, these guys are serious. They know what they're doing. They have all their ducks in a row, and they're experienced. And assuming they have the capital or the partners, they can probably do more. So I even realized that closing deals was helpful in general versus not closing deals. And then sometimes there's no such thing as the perfect deal. And so if you close a deal that just gets you some momentum, helps you build a relationship, that can lead to the other deals down the road for people who are looking to scale up.
Okay, no, I'm glad you mentioned that point because you're basically investing in a relationship, right? Basically, you're buying these small deals just to, number one, see how you work with your new partners, right? It's a new partnership. You kind of want to stress the system in a way. Number two is you're building a relationship with a broker. Is it the same broker that you used in 2015, 2017, or is it like a different broker, different market?
These were actually all different brokers. So the
Okay.
5 or 6 deals we closed, there was not one repeat broker, actually.
Okay.
All
Okay.
different brokers. Yeah.
So you're basically kind of spreading out it's the various brokers over different markets, I'm assuming as well, right? Like just throughout the Midwest, or you concentrate in one state?
We concentrated actually in Ohio.
Okay.
So in Ohio, specifically in Cincinnati, and we closed these deals with different brokers in the market. And those relationships actually have really paid off, because they've led us to other relationships and other deals, even though they were smaller. But now we're getting presented with a lot more opportunities, and the market's not so big, so brokers kind of know brokers. And as long as you have a good experience, I would share that with the audience too. Trying to make it a good closing experience for your brokers and smooth, and not create too many problems, because the community is not so big. And if you have a good track record, try to keep a good reputation, and that will help you in the long run. Assuming you want to go the broker route. Of course, if you're going off market, then It's seller by seller, and that's a good way to pursue a lot of deals actually, and get access to those off market deals, which can be really good.
Yeah, yeah. I'm glad you mentioned that because, for me, my number one skill is being easy to work with, right? So if a lender asks you for documents, give it to them timely. I'm usually within like an hour or two. Like if when they email me, I can at least respond. Same with brokers, right? Like if they need you to do something, or I'm actually very proactive, or because I've done so many deals already myself. Like you kind of know the steps, right? In
Mhm.
terms of what to do. So just getting all your ducks in a line and making it's easy for them. They like working with you, right? So unfortunately for me, I haven't had any. There's some brokers that I've been engaged with in like Oklahoma. I complete opposite route of you. I did all off market deals, to be honest, using direct mail. I know you use a broker, you had success with that, but for me, it was just hard because like the brokers that I'm working with, they're sending me deals, and usually when they say off market, they're still shipping it to like their list of 200, 300 other investors. So it didn't really feel off market to me. Versus when you send mail, I mean, yeah, there's people sending mailers too, but if they call you, at least at that moment, you're kind of like one of a few,
Mhm.
right? So, and then on top of that, like just the brokers that I've worked with, like they just are so terrible underwriting the deal. And like none of the deals that they sent me ever penciled out. And my
Mhm.
offer price would just be like so much lower that like of course the broker's not going to be motivated to work with you because number one, I don't have a track record with them, right? So I
Mhm.
never worked with them. And number two is that like they're like, oh, I don't want to waste my time. I'm like, why do I want to work with this guy when the offer feels so low? Because I'm making offers that make sense for me. So that was kind of the struggle that I had. But definitely, hearing your story, it's more motivational in the sense of like, yeah, like once you close one or two, unfortunately, brokers are very transactional. They just want to give the deal to the best horse, is what I call it. If they know that you can close and that they get their 3% commission check, that's all they care about. Um, they'll bring you deals moving forward, right? And obviously, you're easy to work with as well. So, kind of that's was my experience. Like I said, I haven't had a good broker experience yet. There's still this broker that sends me deals and geez, like it'd be like $500,000 over what I'd pay. And I just tell them like, hey, like um I can offer $500,000 less, but if it's not even worth your time to write an offer, then let's not do it. And I would say, but if you give me, I'll pay that price if you do creative financing. And at that point, the brokers hit or miss. Like some of them don't even understand what the heck creative financing is. Or if they don't understand what it is, it's easy to say, you know what, this guy seems like too much effort to work with. I want to move on to my other list of buyers. So that's just kind of been my experience, at least in Oklahoma. But that definitely is a great way to get deals if you can. So let me kind of dive into your syndicate. So that three are kind of your three was it apartment complex portfolio of 133 units.
Mhm.
Um, Kind of how was that process work? Can you kind of describe that process, like how the deal was brought to you? Kind of how you made the offer, how you underwrote it, and you know all that whole thing from A to Z.
Yeah, yeah. So, as I mentioned, the momentum that we got in 2022 was really key. And I'll take a step back there too, where it wasn't so simple as in 2022, all of a sudden we just got a bunch of deals. So I had actually been trying to get get a look at these 80, 100 plus unit deals since probably 2021. So making a bunch of offers, just getting to close to the finish line, not quite there. Talking with a lot of investors, and so it was probably almost a year. It took about a year to just get any kind of deal that penciled out and made sense in 20 from 2021 to 2022. And then for the first syndication project was from 2021 to 2023, which was actually 2 years. So it was quite a long process. And some people get it a lot faster than that, and some people are similar time frame to me. And so it was a lot of patience. It was it was hard, but that momentum that we got in 2022, we closed a 41 unit deal with a broker, and we've been looking at their deals for a couple years at that point, and knew that they were pretty big in the market. And when we closed that deal, that showed that we were able to get the deal done, one, and then two, also during a challenging interest rate environment. At that point, this was probably August, September of last year, interest rates started going up. So that's probably 3, 4 hikes already into the new interest rate. So rates are in the sixes, and they used to be in the fours and the fives. And so a lot of buyers got scared away, and we were able to close, still get the deal done, and we tried to make it as easy as possible. So we didn't change, even our loan terms changed a little bit, but it wasn't so bad, and we didn't try to go back and change our terms with the seller, and we closed the deal. So another deal came on market actually in early, probably late last year after we closed that deal. So fourth quarter or first quarter of this year, 2023, and it was the same broker. So because we closed the deal with them, we had a good relationship with them. And we underwrote the deal. And at first, we actually saw that deal floating on the market probably in the past 8 or 9 months, and it was so overpriced we didn't even bother. But just like some experiences that you've had, anytime the broker touches it, the price just goes skyrockets, and it just doesn't pencil out. It just doesn't make any sense. So that deal we didn't even look at, and then came back on market with this particular broker that we closed with. So that last broker that said, "Hey, well, you can sell it for this big price," they couldn't deliver it. Switched to the broker that we worked with, and we started underwriting the deal. And then we said, well, we saw the deal floating around at this price, and don't want even want to waste your time. We're not even close. And then they said, okay, so what is your number? And we said, well, let's take a look at it. Did some numbers, did our underwriting, and said, okay, we're probably going to be around this range. What do you think? And they said, well, just put it in. So we put in an offer. It was pretty low. It was a low ball, and we got into the second round, the final round. And sellers at this time were getting a little bit spooked about interest rates, the environment. They're going up, and buyers are getting a little bit afraid. So we went into the second round, and we said, well, okay, we will push up our price by a little bit, but this is definitely our stopping point. And it was a little bit higher than our first round. So we submitted that offer, and then we waited for a couple of days or maybe a week, and then that following week got an email and said, congratulations, you got awarded the deal. And that was a big day. That was a big surprise because our offer was quite low compared to what they're asking, listing, and then also what the pricing guidance was. But anyway, that was some really positive news and a pretty exciting day. And then called the broker and just said, okay, we're excited to do this deal, and let's move forward with it. So from there, we did negotiation and went back and forth, put our contracts together, and eventually that kind of kicked off our process there.
Okay, great. And kind of share like how did you do diligence? Like what did that process look like for you guys?
Yeah. So diligence process is, I guess I'll start from the timing standpoint. So usually we have something like a 60-day close, 30-day physical due diligence, and document due diligence. And usually we'll add another 30-day extension if we need. So that's to build in some buffer time to close, lender underwriting, all of that stuff. And we did that, and then started requesting. We have basically a standardized checklist. You might have something similar of, okay, we need rent rolls, we need leases, we need collections and all the contracts and insurance. Basically a big list of documentation that we need. We have all our questions on the underwriting, send it over to them, and then we'll start receiving lots and lots of information. So it's going through all of that. That's the document side, and then the other side is the physical side. So physical diligence. So I went out to the market, Cincinnati, and spent probably about 3 weeks there, 3.5 weeks. So at that point, we identified a property management company that we thought would be suitable for this property. They manage properties in the local area and also have experience in this local market, have been managing for a couple years. So we got them very involved in the diligence process. They brought in their contractors and their vendors for their roofers and plumbers, and basically we did a scope and the full process of inspecting basically everything, and then reviewing all of that and figuring out, okay, what's a deferred maintenance, what are things going to cost, and how does this factor into our budget. So quite detailed. And then we also saw almost all the units. I think we missed maybe two or three of the units because of a dog and a big dog, and somebody had COVID, and so those are the units that we didn't go into. But otherwise we went into all of them and had pretty detailed inspection reports. Since it was a big project, we wanted to get a good idea of the condition of all the units so we can renovate and do our budget properly. So pretty big effort. Took a couple weeks and a lot of parties, but that was how that process went.
Yeah, I'm glad you mentioned that process because like due diligence for apartment complex, as you know, is way more expensive than single family homes, right? Like single family home inspection, it's like $300. But depending if like for my 26 unit, it cost me like around $4,000 to inspect all units. At 133, you can kind of do the math there, right? It definitely adds up. And another thing that you did well, I thought you did well, was you inspected all units. Because a lot of times they'll ask you, do you want to sample or do you want to do all of them? And I always say, do all of them because you don't want any surprises, right? Like you can miss a unit that's completely burned down to the ground, and that's going to affect your underwriting significantly, right? Or how much capex you need, or how much maintenance or reserves you need. So, I'm the same as you, where I inspect all units, right? Don't That's an expense you don't want to skip on.
Hmm.
It's just the cost of doing business, and obviously you did 133 doors, looked at all units besides two, and that takes a long time, right? Like it took like just for 26 units, it took 8 hours, and we had like 3 4 people there. So imagine 133 units. It's a probably a week 2 week process. And then what's nice too is you brought your property manager there, and it's always encouraged to bring your property manager there because they're going to see things, right? They can see like, hey, these units can get this amount of rent, or these units need this much renovation to get this much rent. And because they bring their contractors in with them, you can get bids for everything. So during that process, that's when you start getting bids, and that's when you ask for seller repair credit, right? That's what I did. They can say no, it's fine. But that's what's nice about due diligence is if you kind of spend that money, do your due diligence, you know exactly what you're getting into, and that you can, make kind of educated decisions. But, even despite all the due diligence, as owning apartments, you can turn every stone. But once you take over, you'll always get, blindsided by one or two things here and there. So that's just kind of based on experience. But so you kind of mentioned these three property or these 130 doors are across three properties. Like, are they kind of close by where it's kind of like economies of scale, or is it like kind of like what's the distance between each of these properties?
Yeah, good question. The distance is about 2.5 miles from each other. The furthest property from end to end is about 2.5 to 3 miles. So that is a about a 7-minute drive. And our idea with how to manage this is all under the same manager, basically. One manager for the three properties, one maintenance person for the three properties. And that scales for a little over 100 units. We're actually syndicating 76 of them. But the management team is the same across the board, and that is how the prior owners and the sellers actually ran it as well, and we saw that as a pretty good model. They had some good economies of scale, and we just wanted to duplicate that to spread out the cost across the properties and be able to also give the level of service and attention that's needed for these properties and not have it be too scattered site, for example 5 units and 10 properties just in a bunch of different places. So we really wanted to concentrate them as much as possible.
Okay, does the maintenance person and property manager actually live in one of the units? Are they live in, or are they just kind of nearby?
They're not live-in, so they're nearby. And for two of the properties, actually, there are management offices in the basement area, but we actually are not using the management office at one of the properties, and the other one we actually plan to convert to a leasable unit. So we're going to do some rehab funding on that particular unit and turn it into something leasable because we don't need management on site. So that's going to be actually part of our value add program.
Okay, okay. Yeah, let's try and dive into your value add program. So, what's kind of your strategy for this 133 doors that you just acquired?
Yeah. So I'll focus a little bit more on the 76. That's our syndication and what our plan laid out is for that. So we are planning to renovate about 16 of the units that are currently classic. And on those unit renovations, we're going to put in about $8,000. And the renovation scope is going to be flooring, paint, fixtures, bathroom, counters, cabinets, and new appliances. So pretty standard renovation package. And what we're aiming to do though to differentiate is to upgrade one step above the competitors. So these properties actually have already received a lot of renovation from the previous owners and who put in Close to a few $1 million actually into the properties already. And so we're actually building on top of their renovation process. And for us, this is what we consider a light value add. So pretty low amount of risk we think because it's already cash flowing and we are just kind of moving it to the next step and getting additional cash flow from it. So renovating those 16 units and we're going to get rent bumps of anywhere from 150 to $250 per month, which is pretty good. And then that's one component. The second one, as I mentioned, is we're going to convert that management unit. So we're going to put in about 15 to 20,000 to that unit to convert it into something leasable. So it already has a bathroom and it already has the floor layout. And we just need to build a kitchen in there and some additional egress and windows. And that's going to generate another $700 or $800 per month. And then we are also going to implement utility billing. So they've already started to implement utility billing across some units, and we're planning to charge anywhere between $35 to $45 per unit per month for water, sewer, and trash bill back, just a flat fee. And we're not counting by usage because that's a different type of program with rubs and et cetera. And you need to track that separately. So we're just billing that as a flat fee. And those are our value add drivers for this project.
Okay, great. Yeah, I know. So it's probably master metered, right? So basically, you're just kind of billing a flat rate to each unit. Like sometimes, for example, one bedroom might be like $35 a month, and then a two bedroom might be $45 a month, right? So that's kind of what you're referring to as rubs. Um, yeah. So you actually delineate. Do you guys actually delineate on the lease? Like, okay, this is the base rent, and this is the flat fee for the rubs. Because to me, some property managers I talk to, I kind of gone back and forth with them. Like, they just want it like, why just increase the rent by like $50 and that covers your utilities, right? But some are like, no, we like it separate. So I don't know. I kind of heard a mixed bag. I get at the end of the day, it's just more money for the property, and you're increasing the NOI, and it's increasing the value. But I definitely can see a positive of separating it out because some people they only focus on like the base rent. They don't care about, oh, there's an additional like $50 for water, $50 for parking, $50 for this extra amenities. So I'm not sure what your experience has been, but that's kind of been mine. It's kind of been a mixed bag in Oklahoma for me. It's actually not common to separate out Oklahoma, but maybe it is in Ohio.
Oh, got it. You're talking about the utilities and the rent all in one payment?
Yeah. So basically, it's like, I mean, the tenants, they pay their own like electricity and gas, for example,
Hmm.
but the water and sewer, like instead of just saying, hey, the rent in Oklahoma is $700, right?
Hmm.
Instead of saying $700 plus another 50 for water and sewer, they'll just be like the rent's 750.
Hmm.
So it
Got
just
it. All
includes all of
together.
that. Yeah, like at the end of the day, you're paying 750, right? Whether it's
Hmm.
750 including it, or you're paying 700 plus an additional $50 for water and sewer.
Hmm.
So I just kind of experienced the people looking at me like I'm crazy when I say, "Oh, do we bill separately for water and sewer?" Some markets are not used to that. In California, definitely in apartments, they usually will bill you for water separately
Hmm.
because especially in rent control, it matters. Um, so that's just kind of been my experience. But yeah, at the end of the day, the concept is you're getting more income, right? You're finding ways
Right.
to increase the income. Because you increase the income, you increase the NOI, you increase the value at the end of the day. So yeah, I'm not sure if you have any more thoughts on that point or.
No, I think yeah, each market is a little bit different, like you said. So for Oklahoma market, it's all together. For Cincinnati, I think it's becoming more
Yeah.
common now to bill back for the water and the sewer. It was less common before. Usually landlords would just pay that. And so now they're actually passing the cost back to the tenant and in some fixed reasonable way. And so actually that's been helping a lot of the value add in that particular market because it's a new type of income that was not as common in the past few years.
Okay. And then I guess my next question is like kind of what's kind of your exit strategy with this $133 or the.
Yeah, so for our exit strategy for the syndication, it is a 5-year hold. So we close this year. We will do our value add over the next about 24 months and renovate our units, convert the management unit, get our utility bills, and then build back to the tenant. And then it will be a stabilized property, and then we'll just continue to increase the rents every year by inflation or a little bit above inflation, and then the investors are going to get the cash flow from that. And two parts to our exit strategy. So one is if we get to the third year or the fourth year and we see a good offer opportunity or a refinance, we will entertain those. So we could sell early or we could refinance. And then by year five, our plan is to sell the properties. And once we sell the properties, then we will return all the capital back to the investors with a preferred return. So they're getting paid before we get paid anything as the sponsors and the managers of the project. And then we will have a split after that between the partners, limited partners, and the sponsor team.
Okay, got it, got it. And I guess with how you kind of structuring, I guess between the general partners, are you guys putting any money in the deals, or are you just raising all the money? Like, how do you typically structure your syndications?
Yeah, so we have a co-investment with the LPs. So we're investing some amount of money, and then the rest of it is being raised from the investors. And then as far as our structured, we have a 7% preferred. So preferred meaning the investors are going to get paid first, the 7%. And then after that split, then it gets split by 70/30. So 70% is going to go to the investors and then 30% to the team. And we don't have any additional splits beyond that. We're just trying to keep it simple. So 7% and then split after that.
Okay, great. Yeah, so what you're alluding to is waterfall, right? Once you get a
Right.
certain return, the profit split might be 50%, LPs and 50% GPs. But I'm kind of in the same area of you, where like the simpler it is, the easier it is for people to understand. Like when you get
Hmm.
to explain things that people understand, and you're trying to raise money, they're gonna say no,
Hmm.
right? So when you keep it really, I say KISS, keep it simple, stupid, right?
Hmm.
So, the fact that you're giving a 7% preferred return is rare now, especially with syndication models. That's definitely an advantage of doing, I'd kind of say this is kind of smaller multifamily, right? 133 units. It sounds like a lot, but in the syndication space, like some operators will not even look at deals unless they're like, 200, 300, 400, 500 plus, right? Depending
Hmm.
on the scope that you get. But because you have these smaller multifamily deals, you can offer, preferred returns. So I'm not sure. Would love to kind of hear your input on like kind of your thoughts between, kind of the smaller multifamily, and by small I mean like, like kind of less than 100 doors, to kind of the larger multifamily. So I'm sure you had experience on both sides.
Yeah, I think as far as the structure, I haven't seen it be that different. For example, as far as the splits. So what we've seen that's different is a different kind of preferred return. So it could be sometimes a five, six, seven, eight, so around there, and then returns of cash flow could be 6, 7, 8%. So usually you're targeting somewhere between 1.5, 1.6 to 2 times your money. So let's say you put in 100,000, and over a 5 year period, you can expect to get about 160 to 180,000 at the end of 5 years, which is pretty close to doubling your money. It's a pretty nice return if all the numbers hit the target. Those are the projections. And yeah, I think beyond that, the size, yeah, I think it is more popular to do some of the larger deals because the sponsors, that's more in favor of the sponsors financially. They can get more fees and get more participation in the deal. So that's kind of the progression for people. And eventually, I think for us, we're starting off on a slightly smaller size, and eventually we'll hope to progress to some of the bigger ones as well. And it's a similar amount of work to do an 80 unit versus 150 or 200 unit. It's just a little bit more, and so that's what I share with people too. Is just it actually sometimes is more work to do a 4 or 10 unit than it is to do a 30 or 40 or even 50 unit, because you probably can't support a whole lot of staff on some of those smaller units, and it's a little bit more risky if you have vacancies versus on those bigger units you can support more vacancies or some downside, and more managers are motivated to work on bigger properties because they can actually make more money that way, especially if you're in out of state or doing long distance investing versus managing it yourself, which is a whole other discussion. But our goal is to really not manage ourselves, and actually we can't because we're investing out of state. And so we try to find attractive opportunities for all the parties involved, for lenders, for brokers, for management companies, and also for our investors. So bigger scale tends to benefit more parties overall.
Yeah, and as you get to larger deals, that's when you get the non-recourse debt, right? So
Mhm.
as the GPs, you're not personally, liable for it. But when you're doing smaller multifamily, like typically, 30 to 50 range, sometimes you do have to like put that personal guarantee. And that's the risk that the general partners will have to take, if that's the route that they go. Um, so that's why a lot of people like doing the larger deals as well. But it's smart that you're building your track record with, smaller deal first, relatively speaking. Once you go full cycle, you have a track record. It gets easier and easier as you get more experience. You have more trust with investors, and that's how people scale like big time, right? That we've seen people do. And definitely, you hit the nail on the head, right? Like whether I'm managing a 5 unit apartment complex or like a 50 or 100 unit, it's the same amount of effort, right? Like for me, I do once weekly calls with my property manager, and whether I'm talking about 50 units, 5 units, 100 units, it's the same amount of time that I'm spending, right? Um, so you're definitely right about the economies of scale. But like I said, there's definitely some trade-offs, right? Because with the smaller multis, you can take those deals down yourself or with like one or two partners. But obviously, if you're doing it the 100 unit range, typically you're gonna have to syndicate and raise money and bring in limited partners on those type of deals, unless you're making crazy amount of money yourself and taking those deals down. So I've definitely gone back and forth because yeah, I hit the point where I ran out of my own money, right? I basically ran out of money, and there's eventually a point where you just have to syndicate if you want to grow and to scale and to make it a bit easier as you scale as well. So I guess with that, what's kind of your plans for the future? With the syndication route.
Yeah, yeah, definitely plans for the future. And I just wanted to emphasize the points you made, which are really right as far as the risk profile. So for some of your listeners, if they're looking at the 5 or 10, usually that's recourse. There's really no option for non-recourse until you get to pretty much probably $1 million loan, or if not bigger. And what was sort of a big shift, I think, is when we bought that 41 unit, and the loan was more than a million on that one. And that was the first non-recourse debt financing that I took on. So compared to the 4 units or the 2 units that had recourse debt, actually I have less risk with this 41 unit, which if you think about it is doesn't really make sense actually. It's how do you have less risk in this bigger unit than a small unit? But to kind of explain how that works, the lender only recourse versus non-recourse. Recourse just means the lender can go after your personal assets if you somehow default or miss your payments on a loan. Non-recourse means the most the lender can take is that property. So with this, even some of these 4 units or 10 units, they can go after my personal assets basically if I somehow default on this, versus on this 41 unit, if something goes wrong, the most they can take is the property, which of course is not good, but they don't have unlimited ability to go after you personally, which can be very scary with some of these big liabilities. So that's, I think, one of the definitely big points of, or big benefits to the bigger properties. And from an investor standpoint, as an investor, they are only limited to their investment loss. So they are not liable for if the property gets taken away or anything like that. That's most liability is actually on the sponsor team. So they technically have unlimited liability in the project. And to your question about what is the future for us, so we launched this for a syndication deal, and we are hoping to close it within the next few weeks, and we are looking at more. So looking at more projects, similar type of size. I'd say our sweet spot is probably 80 to 200 units, somewhere around there. We like the Midwest markets, and we're going to continue to look for more projects. And for us, investors are number one. They're our partners, and we want to help them achieve their financial goals. If it's, hey, shaving off 5 or 10 years off of your future retirement, or figuring out how to get more financially independent, or saving up for your kids' education or more vacation time or whatever it is. We find that as the value that we want to help people with. So partnering with people who are planning for the future and want to diversify into a real estate investment and don't want to do the work, or just don't have the time or interest in doing it, or just don't want to take the risk. So those are the people that we hope to work with, and want to continue to bring more of those opportunities in markets that we think are good, and keep growing, growing for the long term. And so we'd like to, find a dedicated group of investors to work with, and partners, and hopefully just grow with them, and see how we can help them. And then for me, my passion is financial independence and kind of control of your future. And so I'd like to be able to offer that to other people as well.
Okay, great, great. I guess before we kind of jump into direct mail, any kind of last thoughts that you wanted to share with the audience?
No, I think we covered a lot of it. I think for people in your audience, it's you're sharing a lot of great information out there. If people want to do real estate, I think the first thing is just getting educated. So many ways to do it. You don't even have to really invest. You can just be a lender and just say, hey, somebody pay me some amount of percent, and you become a borrower. So just whatever the strategy is, there's so many. Just figure out one to get involved with, and just start taking some action. So I think that's a great way to get involved. And there's so many ways to get educated out there. So books, podcasts, just a matter of getting started. And I would urge people just to take action if they're serious, because it gets to a certain point where you've read all the books and you've listened to all the podcasts, and now what's next. So just try to take some action and learn from people who have been doing it. I think that's a big one.
Yeah, I'm glad you mentioned that because yeah, the hard part, it sounds the easiest, but the hard part is people are taking action, right? Like a lot of people who say they make an offer, they never do. Like I know people who've been saying, I've been trying to get into real estate for the past 5 years and they still don't own any real estate. And fast forward 5 years, I own 90 units now, right? So that's the small distinction between taking action and not taking action. And it compounds, right? It definitely compounds over time. So great. Okay, great. Thanks for sharing your story. I definitely learned a lot. I'm sure my audience learned a lot. So I guess the floor is yours. Like, what questions do you have about direct mail?
For direct mail, yeah, I mean, I'd be interested in just kind of understanding your process. How do you get the list, let's say? Who are the vendors that you use? Do you outsource it? Just if you can kind of outline what that process looks like.
Yeah, yeah. So, for those of my audience, I do have a video on YouTube about direct mail that gives like much detail. But at a high level, what I do is I use PropStream for my data. And I have referral links to all this in my link tree, down below. But I use PropStream for my data, and they have a lot of multifamily filters to pick from. I think it's around maybe 10 to 12 different filters. So it's going to be like garden style apartment complexes, high rises. Sometimes it's commercial, duplex, triplex, fourplex, 5+ units. It's like 5, 10 different filters. I'm sorry, 10 to 12 different filters. And it's based on the classification of the county. And unfortunately, as you know, or maybe you don't know, the classification of county is very inaccurate. Like sometimes it could be a 16 unit, but they classify it as a quadruplex because it's 4 quadplexes. But in reality, it's a 16 unit, right? Or it could be classified as a duplex, but it could be 10 units, but it could be 5 duplexes. So unfortunately, you do have to kind of include more criteria than you would like to hit a wider range of properties. So when you do send the mailers, you might get people calling you where it might be a retail strip center, it might be a duplex, might be a triplex, might be a fourplex, right? So what I do personally is I try to wholesale those deals, and whatever money I make from those deals at wholesale, that kind of funds my direct marketing campaign. So kind of summarize, I use PropStream for my data. I just got introduced to Property Radar as well. To me, I like to kind of cross-reference my market with PropStream and Property Radar and see which one has the most leads. And then from there, that's how you generate your mailing list, right? So it's pretty easy there. And at that point, you typically can download your data in Excel. And at that point, I send that Excel sheet over to Yell Letters Complete, who's a company that I use, have a referral link as well to them. They're a third party mailing company. They specialize in handwritten letters. So it's about $1. When I was doing it, it was $1.50 per letter. I think it increased now. It's about maybe $1.80 per letter, given inflation and, wages going up. But what I did was I would send 300 letters a month. And I don't know why I chose, people ask me why 300, because my market in Oklahoma had around, I think, 1,800 letters or 1,800 leads throughout the entire Oklahoma state. So, I took 1,800 divided by 6. So it's 300 per month. That's how I chose it. Pretty simple. But I would basically send 300 letters per month for 6 months to hit my entire list. And from there, my average response rate was typically around 3% in Oklahoma. Like the less desirable markets, it's about 3%. If you're in a hotter market like, California, Texas, Florida, your response rate's gonna be about 1%. So if you send 300 letters per month in like California, expect to get 3 phone calls, right? In like Oklahoma or maybe in the Midwest, it's not as popular, expect about 9 to 10 calls. So what happens is you're basically spending about $600 a month, close or roughly, between prop stream and your letters for his direct mailing campaign, right? And out of the 10, $600 you spend, you might get like 10 leads that call you. So that's almost like $60 per lead in a way, right? And as you start sending your letters, that when you go off market, you get a lot of people who are not serious, right? There's people that say, hey, you're from California, overpay for my property, you're rich, right? But as you kind of mentioned, we don't want to overpay, right? Just because like we're based in California and we're investing in like, Ohio, like we don't want to overpay. We just want to pay, what makes sense for us, right? So, you get a lot of those buyers. You have buyers where, they're not very motivated. I kind of have I think I probably have some videos talking about kind of buyers that you'd come across, but you have buyers who I call fishers, and they're just fishing for a high price. They're not motivated at all. You have buyers who, maybe they think their property is worth way more than what you're willing to pay. That's also very common. You have people who have no motivation. They just say, well, I'm not motivated, but if you give me a crazy offer, I might be motivated. So they're not really that motivated. And, you have the buyers that are motivated, right? So those are the buyers that, from my experience, if I send out 300, I might get one really motivated buyer per batch on average, right? So it just becomes, as you mentioned earlier, a numbers game, right? And can you do it consistently? So where a lot of people fail is they aren't able to send letters out for like, you have to hit each person at least 7 times to get a response. So if you're mailing a list every 6 months, you have to do that 7 times. That's over the span of 3 to 4 years. And with direct mail and off market, you're not buying properties, you're buying situations, right? Like what situation are you buying from the seller? Are they going through a divorce? Is there a death in the family and the kids inherit the property, don't want to manage it? Is there a disagreement? Maybe there's a partnership that went bad, right? And they want to get rid of it. Or maybe there's disability. Maybe the owner was self-managing it, and and then now they can't because they got in a crazy car accident. So it's just kind of you're buying situations, and it requires doing a lot of trust. To kind of go in specifics with the letters. So my letters are pretty generic. It kind of just says that, hey, I'm Steven. I give a little introduction about myself. I'm Steven. I'm a pharmacist. I've been working for 10 years. I own a portfolio of like, however many units that is. I own 90 units. So it's pretty sizable. And just said, I'm looking to buy properties to slowly scale up so that I can, build financial freedom, or let's say you want to pay for your kids' college, or, pay for whatever it is, right? Make it very personable. Talk about yourself. Don't come off as a huge corporation. I hate people who a lot of people that I work with, they have a fancy Gmail account with S corporation or whatever, like SD, I don't even know, Blue Acres, syndicationfund.com. And you just really want to come off as like an everyday person, right? Like I'm just Steven, hey, I'm just like you. I just want to buy real estate to get financial freedom for myself or for my family, right? The more you come off as a corporation, it turns away people, right? That's just kind of been my experience. So literally when I send out emails or the letters, I just put my Gmail, and it's just like, my name, like Stephen.Nguyen@gmail.com, right? Like it seems more personable. And then even the number I give, it's actually my cell phone number instead of like you give a call this 888 number. That like seems so impersonal, right? So for me, my kind of strategy that I teach, obviously my students and my mentorship is it's just a very personalized letter that feels like it's coming from a friend. Like imagine you just got a letter from a friend who's inviting you to a wedding. That's the type of letter that I want to give. So to kind of dive into the specifics, and sorry, I'm jumping all over a bit today. My brain's a little fried, but I use an A2 size envelope. So that's invitation size. It's smaller. And then what we do is we handwrite the owner's name on the front and we put a live stamp on top, right? Why do I do that? Why is it handwritten? It's coming from a friend, right? Why is there a live stamp? It feels more personal. It's coming from a friend, right? Versus like, I'm sure you see a lot of the direct mail. I receive a lot of direct mail, people mailing me to buy my properties. And it's like printed and a stamp is like that. Like it's not an actual stamp. It's just like, the pre-printed ones. And it just seems so like corporate. And what I do when I get that letter, I just throw it right in the trash. Right. And I know me, it's like $2 per letter almost. So like I just threw away $2 of investors' money because they're not good at setting up the direct mail campaign. So, once again, I do that A2 size envelope, invitation size. At that point, I have a letter template that I use, right? So, for those who want it, you can actually purchase my letter template, or if you're part of my mentorship, that's part of it, right? But basically, it's a generic template. You write your introduction, and basically, I handwrite 3 call to actions on the letter itself. So the first one is I will, hand sign my signature to make it more personalized, right? And I use my doctor title because I'm Dr. Stephen Nguyen. When you have a title, whether you're a doctor, a veteran, a pilot, leverage that title because it builds trust, right? Like how much more credible do I seem as Dr. Stephen Nguyen versus Stephen Nguyen, right? Like if you're investing in the Midwest states, unfortunately, it's mostly, white. They're not used to seeing Asians, right? I'm not sure if you experienced it, but like sometimes they kind of look at you in a different way. They may not respond to you a different way. I have a lot of students where they'll call and be like, hey, you're coming from a liberal state. I hate you. Like what? So there's things that like you have to work against, right? Whether you're, coming from a liberal state and maybe they don't like that. Maybe you're Asian, maybe you're a minority. They don't like that, right? So any way that you can kind of build that trust and leverage that trust. For me, I mailed Oklahoma. I leveraged my doctor title. I never had someone call me, angry, saying that you're a liberal and you're Asian, right? But my other, students who hit the same market as Oklahoma as me, they've experienced that. I think there's just one owner who's just really against liberals and against minorities, right? Probably waves a Confederate flag around too. But but you get a lot of different characters, right? Like, people call you back, cuss you out, they'll text you, they'll cuss you out, they'll email you, they'll cuss you out, right? Just expect that. Like if you door knock, same thing, right? People are gonna give you a hard time. You don't know who you're gonna talk to or who you're gonna interact with. So, just something that you have to go through. But it's just part of the business, right? It's just a numbers game. Don't take it personally and just move on. They're obviously not motivated if they're complaining about you being a liberal, right? They're not motivated. So what I do is I just delete that from my list. I'm not going to contact this guy again, right? So, and then so I handwrote the signature and I handwrite a call to action saying, hey, Wakefield, call me. Steven, this is my number. I gave you a direct call to action to call me, right? So the point of the letter is to get them to call you. That's it.
Mm-hmm.
Plain and simple. Nothing fancy, right? I get a bunch of these postcards. I'm sure you've seen it. A lot of brokerage sends them to me. You see this guy in his fancy suit, like, kind of like this, looking over like this. And then, they're printed at the bottom and there's this fancy, busy postcard that they mail out. I get that. I'm automatically throw that in the trash. If people send that to me, you just wasted $2-3 on me, right? So for me, I do the A2 size envelope. And actually, I don't actually put my name and address on the front side. It's actually, they have to flip it over and then it's on the back side. Why do I do that? It creates intrigue and mystery. Like, hey, who sent this to me? I'm curious, right? And on top of that, what I do is I actually don't seal the envelope. I just tuck the flap back in. So once again, it's like, wait a second. Like, who opened my mail? So you're just kind of creating these mystery points to get people to open your letter. right? And then once they open your letter, they're going to read it. It's obviously you trying to buy their property, and the goal is for them to call you, right? Or text you or email you, right? And once they do that, the key is to respond within 24 hours, right? Even if the response is, hey, got your message. When can we coordinate a call together, right? Just respond, because you spent $300 a month to get this lead to call you, right? So treat those leads like gold. And at that point, once they call you, it's all about building trust, right, over the phone. Like, this is the hard part that I can't really teach, to be honest. Like, for me, it comes a little bit more naturally because I manage about 60 pharmacy staff as a director of pharmacy on a daily basis, and it's like babysitting kids, right? So basically, it's in the mentorship in the course, I have like a checklist of like 12 questions to ask, and the first question I ask is like, oh, tell me about the property. Like, it's a very easy ice-breaking question. A lot of times, people love talking about real estate, right? Myself included. They love talking about real estate as if it's their kid. So they're going to talk about it. Like, don't diminish them at that time. Don't say another question is like, oh, what's a good price for you? Something like that. And, they'll say like $4 million, but in your mind, it's $2 million. Don't go outright and just say, hey, that's way overpriced. Because now you just lost the trust for that person, right? So you can say, okay, like, usually when I get the offer, during the conversation, usually I'm asking about like, okay, tell me about the property. I'm trying to hit, okay, how much do you make on a monthly basis? What's the occupancy? How many are 1 bedroom, 2 bedroom, 3 bedroom? How long have you owned it? If they owned it for like, 20, 30 years, it's probably owned free and clear. So you can do creative financing. What's their pain points? So I can understand how to cater my offer around those pain points. And what's their motivation to sell? Like, do they want to retire? So I can kind of create an offer that makes it win-win for me as well as for them, and to make it more personalized, right? So, a lot of people that work with me is, as you mentioned earlier, why not just give it to a broker? Like, obviously my 26 unit, I bought for $500,000. It appraised at $750K. Had they brought it to a broker, they probably could have sold it for more and made more money, right? But I think because some people, they don't necessarily care about the top price. They just want to know who they're selling the property to, and that this person is going to do a good job to maintain the property. And that's unfortunately where I think it gets lost, especially in the bigger companies. It just becomes like a spreadsheet, and you kind of lose that personal touch, right? Obviously, the underwriting is spreadsheets, but after a while, it becomes an art. Like, the spreadsheet, obviously, it's numbers at the end of the day. Obviously, when people underwrite it, if you ask 100 syndicators if they're conservative, what do you think they're all going to say? They're going to say yes, right? Of course they're going to say yes, but you really have to deep dive into it. Like, is it really conservative? Because no person will tell you that it's not conservative, but then you get humbled once you actually own the property, right? But then with these owners, it's just really building that like trust with them and understanding that pain points. And once you can kind of treat them like a human and not like a number, or like, hey, I need to make 100 offers this month, and you're just number one of 100. That's when you can kind of get these off-market deals. And obviously it's not as scalable, but this is how you kind of hit your home runs off market. So from my experience, I basically bought all my properties off market with direct mail, and I probably walked into about 300K equity day one, right, on both my deals. So yeah, sorry, that's kind of like a high level. Kind of any specific questions?
Yeah, no, super helpful. Just general overview of it. So what, I guess, for you to get, so you're 90 doors, let's say, how many letters was that? How many properties is that? What was like how long did that all take, I guess? Because as we're planning out this campaign, let's say, you set aside a certain budget. Hey, I'm going to do this for a year and maybe get one lead out of it, or maybe zero. Maybe it takes 2 years, or how did that work out for you?
Yeah, so for me, I just want to do 300 letters a month, so it's $500 a month for me. And luckily for me, I only did it for 6 months, and literally from those 6 months, I got 2 deals. My 26 unit, my 20 unit, with instant equity day one. I will say that I'm a little bit luckier because I think even like people told me I've never seen such a crazy response rate. I basically spent $3,000 and I made $300,000 of equity day one through direct mail. That's a huge return, right?
Wow.
On my letter, but not many people will have that success. And I said the differentiation is because I'm able to talk to the owner so well.
Mm-hmm.
And that's just a skill that I've honed for like the past
Mm-hmm.
10 years being a
Mm-hmm.
pharmacist. So that skill is hard to teach.
Mm-hmm.
And for me, I'm very educational, where I like to teach the buyer and be very transparent as to my process.
Mm-hmm.
Right. And unfortunately, that gets a little bit lost when you're working with a group where maybe it's 4 or 5 different partners and it just feels so transactional. Right. That's
Mm-hmm.
the downfall of the broker. They're just very transactional.
Mm-hmm.
Versus me, I'm just like, I want to understand, like, okay, well, you look like you want to retire, right?
Mm-hmm.
Or it looks like your kids don't want to manage this anymore, but they like the income,
Mm-hmm.
right? And I'm explaining to you, like, hey, I'm making an offer to you, not because I want to give you a low offer, but this is all the bank would, this is how the bank's going to underwrite the deal. And this is how they look at it. And based on
Mm-hmm.
your offer price, that bank won't lend on the deal for me. But at
Mm-hmm.
this price, they will. So it's just like making yourself like, hey, me and you are solving a problem together, and you can make, the bank or someone else the bad guy. Or
Mm-hmm.
like just don't make yourself come off as the bad guy. Right.
Mm-hmm.
So it's just kind of that and having that patience, right? Like, some of these mom and pop owners, they even have a rent roll. And I literally on the phone with them. You number one, what's what's how long have they been there? What's the rent roll? What's the security deposit? And I go one by one. It
Mm-hmm.
takes a lot of time, right? Especially if it's 135 units or whatever.
Mm-hmm.
So it's just really providing that customer service and spending that time with them and helping them, right? Like, I work in healthcare, so I'm used to like being very patient with elderly people,
Mm-hmm.
right? And that's the downside of, people kind of our age and our generations. We just want it now, fast.
Mm-hmm.
You're inefficient. But just having that personal touch, and it shows, right? It definitely shows. Like, I want to help you. I'm being transparent, and so I think that was my secret sauce. To be honest, like it's really hard to train. It just takes repetition and practice. But to me, if you do direct mail, you have to be consistent because sometimes they clean out. So the second 20 unit, I sent that letter out 5 months ago,
Mm-hmm.
and he was just cleaning out his drawer, and he saw my letter, and then he called me, and then that's how I got the deal. Right. And then whatever you say you do it. Right. Like if you say you're going to write an offer, do it. A lot of times I'll just say, hey, I ran this deal past 10 lenders, including the lender that you gave me, and they all rejected it because the price is too high.
Mm-hmm.
So you kind of set expectations and priming them down. So, I've had a lot of success with that, obviously, but you definitely have to commit to it, and you have to be very tenacious in your follow-up and show that you care. And that's where most people fail, to be honest. It sounds easy, but that's where most people fail. And
Mm-hmm.
people get discouraged. Like I have a lot of students where they'll do their direct mail for like 3 months and give up. I'm like, you're not gonna get a deal with just 3 months.
Mm-hmm.
You have to do it longer than that. So, that's just kind of my 2 cents. Obviously each market is different. But I imagine in your market, Ohio, it's probably gonna be about 3% response rate.
Mm-hmm.
You might get people who are saying, hey, you liberal, why are you from communist from California? Well, how dare you send me a letter? But that's just kind of goes with the territory.
Got it. Okay. And what was so all your deals were off market, right? The 90 units. And so
Yeah.
how many properties is that total?
So my single families I bought on market. So my 26 unit, my 20 unit, and my 200 lot mobile home park were all off market direct mail.
20 unit mobile home park?
200 lot mobile home park.
Oh, 200 lot. Okay.
Yeah.
All off market. Oh, got it. Okay.
And I got the
And
mobile home park seller financed because I
oh,
went off
wow, seller
market.
financed. Okay.
Yeah. So that's how you get seller finance deals, right? You want to cut out the broker because unfortunately the brokers cannot, like if I tell you Wakefield something and you have to tell someone else, it's like playing telephone, right?
Mm-hmm.
Like the message is misconstrued, trust is lost.
Mm-hmm.
If I can talk directly with you, we can build trust.
Sure.
So they're becoming the bank of creative financing, right? So you definitely need trust in that you have their best interest in mind, that you do what you say you do, right? Especially if I'm in California and they're in Oklahoma or Ohio. So that's how I got all my. So that's why I said I went complete opposite of you. All my deals are off market. All my commercial deals off market. Single family homes I own on market. Redfin, Zillow, right? But all commercial, all off market. I've never worked with a broker. All their deals that they sent to me have been terrible. I've worked with many. All their deals are terrible. I've never had a broker bring me a good deal. I've been doing this since 2017 in Oklahoma. Never a good deal from a broker. Way overpriced, and they usually don't want to get creative with creative financing.
Yeah, it doesn't help them because it just makes it more complicated. So they want just straight cash deal, something that's going to be easier for them, right? That's what the broker wants. So for the, I just wanted to get a little bit deeper into some of these, your conversations and your follow up. So how long? So you're mailing for, let's say, 6 months, and then you got these two deals. And what was the process from getting to that person calling you, and then how many follow up touch points until you actually closed the deal? Was it just, they put out some crazy price, and then you said, well, the lender's saying this, it's like not bankable, it's not going to work, so this is a new proposed price? Like, how many, I guess, conversations, negotiations did it take to eventually get you to the deal? Was that like a month, a couple months? And what was that process like?
Yeah, so for me, mine was pretty fast. By my third month, I got my 26 unit,
Hmm.
and the owner just said, "Make me an offer."
Hmm.
So I just said, "Okay, well, I just give me a rent roll, give me a T12, and I'll make an offer." Right, and then he gave it to me. Obviously they can fabricate it, unfortunately, but assuming it's correct, I just made an offer at test test price, and he took it. Like, it was that easy, and because he just was very motivated to sell,
Hmm.
he wanted to retire. This guy, I just didn't even talk to him. It was all email. He
Hmm.
was a lawyer. He wanted everything communicated via email. So I
Hmm.
was very lucky on that one. The second one, that guy actually like reached out to me. I made an offer. He actually turned it down. But I think I just got really busy in my mobile home park. Kind of forgot about him. And then all of a sudden I remembered him like, 6 months later. And then I just texted him saying, "Hey, like, did you sell that prop 20 unit yet? If not, I'm interested in buying now." And then he just said, "No, I still want to sell it." And I just talked to him and just said, "Hey, like, I know he told me he wanted about 400,000 for it. I underwrote it with a couple lenders. They said that it wouldn't pencil out. So I just said, okay, well, my lender pre-approved me for 350. Would you want to lower it to 350?" And he said, "Yeah." So most of my deals are very easy, to be honest, because they're very motivated to want to sell. So honestly, mine are fast. I'd like to have a little bit of an outlier. It's
Uh,
not the usual experience, but like, I literally just submit the offer, and it's just like, they're just very reasonable people to work with. And I don't know, it's just because of the way I communicate with them, or I don't know. But like, anyways, I just was able to diffuse them so much that like, it was just very easy for me. I either just got it, and things would progress fast, right? If I said make an offer, I make an offer. If I said I'll get back to you on Friday, I'll get back to you on Friday. If I say that this is the current step, just be open and communicative, and text them or call them or email them, however they want to be communicated with. So, like, for my next, when I start looking for deals again, I want to record my conversations actually. And I'm
mhm,
having my students in my mentorship program record their conversations so
mhm,
that we can analyze together how you're doing it and
mhm,
improve. Right? No mentorship I've ever seen or been part of actually will do that. Right? I'm
mhm.
actually doing that for people, and then just gonna upload to YouTube for everyone to learn. Right? So like, that's how much I wish I recorded my conversations when I was just talking to hundreds of owners,
Mhm.
because that would have been liquid gold, to be honest. You know, and to give a lot of value to my audience.
Yeah, that would be huge. And just to understand how you're talking in the conversations, and you know be able to follow along there. For your list as you're pulling it, did you have like a certain criteria? Was it like 20 units plus, and any kind of motivation like ownership period, any filters, or was it just here's the whole list and just kind of send
Yeah,
communication to them?
yeah, just 5 to 100 units
Five
was
to
kind of the
100.
sweet spot. Yeah, because those are more mom and pop owners,
Mm-hmm.
and you're not competing with larger syndicators who want 100 units plus, and then at least 2 years of ownership.
Mm-hmm.
So for me, that I want the biggest list as possible because I want to hit that list, right? So I know some people like, oh, I want 10 years of ownership, but it makes your list smaller.
Mm-hmm.
But it depends. If you're kind of hitting a wide area like the Midwest, then maybe you can make it the ownership a little bit longer. But for me, it's 5 to 100, 2 years plus ownership. That's it. Really simple. Owners and LLCs doesn't
Mm-hmm.
matter. Like, both the properties I bought were under LLCs, but it was owned by one person. That's like me, right? I own LLCs, but it's just owned by me.
Mm-hmm.
So I'm basically like a mom and pop almost. So really simple. Yeah, really simple strategy. Had crazy results from it, and but yeah, I haven't. It's hard to replicate. Definitely, I'm not sure if even I can do it.
Yeah.
Another time again.
Got it. Okay. And have you so I guess when somebody calls you from these, they're motivated, right? Have you considered like texting at all? I know people do a texting strategy, or you think letters has been, I mean, obviously letters have been pretty effective for you. Direct
I
mail.
mean, know your demographic, right? So most people own an
Mhm.
apartment complex are like 60 plus. So
Mhm.
they actually appreciate a letter. Cold texting is actually illegal, depending on how
Mhm.
you do it, because they technically have to opt into it.
Mhm.
But if you're cold texting somebody, it's technically illegal, right? So, a lot of messages will get blocked. And like to me, if I get a spam message, like it's annoying. Like I just block it automatically. Or even cold calling, I block it. It's all spam. It's usually a VA calling you. And it's
Mhm.
just like so annoying. So for me, I like the letters because like it's more passive. Like you just
Mhm.
send the letters out, like I automate all that, and I just wait for people to call me. I'm
Mhm.
more motivated versus if you text and a cold call, you have to hire a VA,
Mhm.
and a lot of times they're not going to be a VA is not going to be as personal, right? You can definitely scale, but they're not going to be as personal
Mhm.
in talking to people. So and the greatest way to get off market leads is building a personal brand, right?
Mhm.
So I hope people bring me deals in Oklahoma because they know that I invest in Oklahoma, right? So it's definitely a way to go. So for me, it worked for me because I'm really busy. I work W-2.
Mhm.
So, I just want to send the mailers out and they call me. It's plain and
Mhm.
simple. Plain and simple.
Right, right. Okay, and they're already motivated by the time they call you, right? So they're a warm
Yes.
lead, and you already know that they're probably willing to sell at some price.
Yeah, they opened my letter and took the time to call
Mhm.
me. Right.
Right.
That took two steps of effort.
Mhm.
So they're definitely more motivated, at least. Right.
Right. And for your list, are you so how big is your total list? And are you hitting the same people? Like, are you rotating, or you hit the same people like just 6 times in a row until until
Yes.
you move to like the next batch?
Yeah. So basically, you want your list. You want to hit your one prospect at least once every 6 months.
Okay.
6 months is kind of the sweet spot. If you do too soon,
Okay.
it gets annoying, right?
Okay.
It's like every month is annoying. So for me, if you're sending 500 letters a month, you want your list to be at least 3,000. So you can
Mhm.
hit that list once every 6 months. But you have to
Mhm.
hit that list 7 times at
Yeah.
least, right? Yeah. So that's kind of how my frequency.
So if you need to hit that list 7 times and you're doing it twice a year, so that's about like a few years, like three,
Yeah,
4 years.
three, four
Okay.
years. Yeah. Buying situations, right? Like
Yeah.
your situation today might be okay, but in 3 years, maybe something bad happened and they're a different situation. So yeah, that's why you have to be consistent.
Got it. Okay. And for the students in your group, what has been their kind of success rate or like timing? Have they been able to, get something within a few months or a year or 2 years, or is it?
Um, so the downfall of a lot of my students is like they can't consistently do it.
Mhm.
So I actually offer, if you look at my mentorship, I actually offer the direct mail where I do it for them for 6 to 12
Mhm.
months.
Mhm.
Obviously it costs more money
Mhm.
compared to doing it yourself, right? But then basically I just do it for you. So
Mhm.
of course you're going to do it. But usually like the percentage has been about right. It's been about 3 to 10 leads
Mhm.
per month,
Mhm.
depending on the market. And I've one of my students got a crazy deal in downtown San Antonio. This person owned it for 3 generations and she wanted to
Mhm.
sell it, and it's owned free and clear, obviously, right? They owned it for three
Yeah.
generations.
Right.
And fortunately he wasn't tenacious in his follow-up and kind of gave up, right,
Mhm.
on that deal. So it's just really you saying the letters and being tenacious in your follow-up and making the deal work. Because like that property, I mean, downtown San Antonio, that's prime, right?
Wow.
And
That's a
and
great
and
location.
and it's owned free and clear. So I'm like, dude, you can pay whatever
Mhm.
price they want, just
Mhm.
the terms. You just want the terms. So that's kind of been the downfall of a lot of people is they just can't do it consistently and
Mhm.
follow up and be tenacious with it. That's my strength. That's how I bought 90 units so fast. But that's where my students are failing. They lose motivation after like 1 or 2 months. I just said, you got to keep on going. Like you got to keep on going and make those offers. And I just said, recorded conversations and,
Mhm.
maybe you're not talking the way you should be. Cause I can give you a list of questions, but how I interpret versus you, it's gonna be different. Right.
Mhm.
So that's why I pivoted and said, you know what, let's start recording these conversations and I'm going to coach you on how to do it better, um, and record that and release it, to everybody for free. So, it's just really that repetition. And because for me, like I said, I've been doing the leadership for like 10 years. So it's very natural for
Mhm.
me. I'm very
Mhm.
natural at it. I don't need any like training or practice on
Mhm.
it. It's just very natural.
Yeah, I think that's the big thing, right? Is that human element to it, right? Everybody can kind of figure out how to get the leads, but the difference between you get the deal and you don't is just that human element, interaction, and the soft skill of helping them solve the problem and understanding the pain point and how can you add value to them and just be a reliable person. So definitely that makes sense.
Okay, cool, cool. Well, I'm crunched on time. Unfortunately, I had a hard stop at 3:30, but thank you so much, Wakefield, for hopping on, um, sharing your journey, and yeah, would love if you want more questions about direct mail. Happy to answer more questions at a later time.
Yeah, for sure. No, definitely super helpful. So thanks for sharing all of this, and love to keep in touch on it and maybe try it out. And yeah, if any of your listeners want to reach out to me, happy to
Yeah,
share my contact or website if people want to find out more.
yeah, just give me the link, and I'm happy to drop it down in the description when the video is released.
Okay, that
But
sounds good.
all right, man. Thank you so much.
Thanks a lot, Steven.
Yep. Have a good
Okay,
one.
all right, everyone. You too. Bye.